I'm David Phillips, and I am the CEO of Estate Planning Specialist. Todd Phillips is the president who's walking around, and make sure that you have the evaluation form as you go through the talk today. And as I'm saying things that impress you, that you want to know more about, make sure you check an indicator that you want to know more about those. Well, we're going to talk about the Secure Act that just passed on January the 1st of this year. I thought long and hard about how to start my presentation today, and I kept in my mind thinking about medieval villages being pillaged. And this is what has happened here. And so I got this slide. I think it's pretty descriptive as to what has happened to us as Americans. And most of us don't know, and that's why I call it the stealth estate tax, because it's kind of under the radar. I was talking with an insurance company official the other day, 20 days after the passage of this act, and he didn't even know that it had passed. So if he doesn't know, most likely the population at large doesn't know. So we're going to be talking about this Secure Act. The village has been pillaged, and it's absolutely the truth. We are in a situation where things have happened that you need to know about, and the ramifications to you and your family. Your estate has been looted, and your children and grandchildren have been robbed of their biggest asset in your estate, which most likely is your IRA. So by a show of hands, how many of you here today have an IRA, 401k, 403b, defined benefit plan, 417, any kind of a deferred retirement account? Raise your hand, please. So I was hoping that everybody would raise their hand, because you should be here to know about this, because that's obviously, and I'm in the same boat that you're in. We are in a situation right now where we need to understand what these rules of engagement are. So let's talk about the Secure Act. First of all, it became a law in January of this year. It passed the House by 417 to 3, the Senate by 71 to 23, and President signed it into law on December the 20th. Now, it became law on January 1st, so we are in the Secure Act world now. Now, we are, the world as we know it now, with regard to our retirement accounts, is in the Secure Act world. But the most important thing, and what we need to discover and examine closer today, is that the stretch is dead. The stretch is totally dead for the majority of our recipients, our beneficiaries. So let's talk about the rules of engagement here when we're talking about the IRAs. Now, when I say IRA, I'm going to say mostly IRA throughout this presentation. But I'm trying to, when I say that, I'm encompassing every tax sheltered in retirement account that we call it in the industry qualified accounts. So that's 403bs, every defined benefit plans. We're talking about all of those things wrapped into one, and I'm just going to refer to it as an IRA. But in this qualified account rules of engagement, we know that the money goes in, it's tax deductible. We know that the accounts accumulate tax deferred, and taxes are charged on December 31st if we take any money out. So it's been deferred all the years. When we touch it, we have to pay taxes on it. If we draw it before 59 and a half, we have to pay a 10% penalty. We also know now that there's a new rule for the Secure Act that we don't have to begin our required distributions until we're 72. Now, if we've already started our required distributions, we can't go back. We have to continue. So it only impacts a few people, and it's kind of a bone that was thrown to us, the 72. It's kind of an easier accounting than 70 and a half, really, is the way I look at it. But it really isn't anything to impact us significantly. Then we also know with qualified accounts or IRAs that your spouse, your surviving spouse, can roll your IRA at your passing tax deferred. So they get to keep it tax deferred. Those are the rules. Everybody understand those are the rules? Those have been the rules except for the 72. So we know that we have to take required distributions now. They start at 72. What this did basically is it deferred it a little bit, but it increased the distribution because they're using the same factors. So at 72 now, If I have $1 million IRA, my required distribution is $39,000. That's how much I have to take out. If I'm 75 and I have the $1 million IRA, it's $43,000 and so on. And so it just increases. It continues to increase year after year. That's the RMD, required minimum distribution. How many of you love required distributions? Raise your hand. Okay, nobody raised their hand. That's exactly correct. You answered exactly correctly. Nobody loves RMDs. Now, some people need RMDs to live on, and that's fine. But usually those are states of a smaller amount, and they absolutely have to have this money to live on. Now, let's look at the rules with regard to the non-spousal beneficiary. Who's a non-spousal beneficiary? Your children, your grandchildren. Anybody that is not your spouse is a non-spousal beneficiary. The tax liability for them when they get money out of your IRA, when they receive it, when they inherit it, it's charged to them on December 31st for any withdrawals that are made. If they inherit your IRA and they withdraw $1, they have to pay tax on that dollar at the tax bracket that they are on December 31st. That's the rule. Now, with 2006, we got what's called the stretch. So they didn't have to take the distribution all at once. They could stretch it over the lifetime. Come to find out, most beneficiaries, when they received the money, didn't stretch. They didn't use it. In fact, mom and dad weren't around to make sure they did it, and so therefore it wasn't stretched. The only way that it could be the stretch could have been insured was if it was in a trust, and it was called a conduit trust. And it made certain that it was stretched during that period of time. Okay, so we have this money coming in, and we know that all IRAs and Roth money must be distributed now in 10 years. That's the new rule. It is called the 10-year rule. We're going to spend quite a bit of time on this 10-year rule. In other words, if I have an IRA and I pass it to my non-spousal beneficiary, they have 10 years now. The clock starts to tick the day I pass away on December 31st. 10 years out, they have to distribute it all. They have to receive it all. There's no stretch. The stretch is dead. It's called the 10-year rule. The logic behind this law is pretty simple. And hear me on this. This is critical. Qualified accounts, or IRAs in our example, were never intended to be inherited by our children. Individual retirement account. That's what it's called. It's a retirement account for who? Not for the kids, for us. We were supposed to spend it. But what's happened is the market's been doing great. The accounts are getting big. I've seen IRAs in excess of $20 million just recently. A $2 million IRA is not an exception. It's the rule now. And this money gets distributed to the next generation. Now, I don't want to be morbid here, and I'm not trying to play on anything. But when Kobe got in the helicopter, he did not know that was it. We do not know the day, the time, and the hour. We can't pre-plan these things. If we die with an IRA and we pass it to our kids, they have to employ the 10-year stretch rule. Period. Plain and simple. We were supposed to spend it and we didn't. So why then are we seeing these huge IRA accounts? Because people in general like to hoard retirement accounts. They like to have the Midas touch. They like to have the gold. They like to have the feel of it. Plus, we can't stop it from growing. It keeps growing. It keeps multiplying, doubling, and tripling. And it keeps expanding. And so we are in a situation right now where we have to be concerned about hoarding this and how much we're hoarding, and we need to think about distributing it a little earlier. What is the number one greatest fear in retirement? Running out of money is part of it, but what is that really telling us? That's telling us that we live too long. basically. The number one fear is longevity, is living too long. We basically, we got the, we're going around on the carousel, and we got the ring, and we got the ring to live too long. And that was our punishment for being healthy and great and everything, and we are living now way past Social Security estimates of 85 for men and 86 for women, or 88 for women, depending on which table you look at. We're living too long. And so the longer we live, the more likely we are going to experience a market downturn, an inflation, deflation, increasing taxes. This is critical. Right now, we are in the Tax Cut and Jobs Act world that Trump created for us. The lowest tax brackets we have seen in 80 years. What's the likelihood of that those taxes are going to increase? Okay, so the longer we live, we may see, I don't know if any of you have read Mark Skousen's latest special report, but oh my goodness, he talks about the socialist and the education system and et cetera, et cetera. The longer we live, the more likelihood is that we'll experience this. We're going to experience these increasing taxes. And the loss of cash flow. We're going to run out of money. We just didn't have enough money. Also, there's a huge likelihood that we're going to have a long-term care event the longer we live. So one of the things that we absolutely need to do as we prepare for this day of retirement, or if we're already in this retirement period of our life, we absolutely have to prepare for a long-term care event. And we have to prepare for longevity. We have to prepare for these days. But by doing this, we are actually hoarding our money because we're keeping it. And so Uncle Sam says, if you hoard this money, you're playing right into my hand. You're actually playing my game, the game that I want you to play. As such, your IRA simply is an IOU to the IRS. It's never been your money. It's the government's money. And when you finish today, how many of you have received the evaluation, have not received the evaluation form? Okay, raise your hand if you have not, because as I go through the presentation today, if something that I say interests you, if it's important to you, check it off. And then when you hand it in, we'll discuss this with you at a later time or at the conference, during the conference. Todd, if you have not received one, please raise your hand and Todd will make sure that you get those, okay? These evaluation forms. With the Secure Act, though, what has happened is that the acceleration of the distribution has now been increased, and it was increased to create tax revenue for the IRS, for the government, basically. I shouldn't say pick on the IRS 100% because they didn't draft the law. The law was drafted by our congressmen and senators. In 2014, the Supreme Court came out with a statement, and they said, non-spousal inherited IRAs are not retirement accounts because they were not created by the recipient for the purpose of retirement. In other words, it was never intended to be the money that the kids inherit. 83% of all retirement accounts are passed to named beneficiaries. And most inherited IRAs are gone in the first year. Now, a lot of the IRAs that are under this statistic are smaller IRAs, and I understand that. If I inherited $50,000 from my mother in an IRA, I probably would use it to pay off my house or the car or whatever. But as I'm telling you, a lot of the IRAs that I am seeing are in the millions of dollars. Is it your goal to create this money, to pass it to the next generation, and have it vanish in a year? Is that what we did this for? Is that why we created this account? Sure, we created it for our benefit, but we are not using it. We're not spending it. The statistics are there. 83% is passed to a named beneficiary. Well, let's talk about the Secure Act and what things we did get. I call these the bones. the doggy bones that we got. We can now continue to contribute up to $7,000 a year in an IRA. We couldn't do that before. We can now put income annuities in the IRA. Well, not yet now, but almost soon we will be able to, which basically means we can take the money that we have in here that's all at risk, and we can take some of it out of risk and create income for us for the rest of our life. And we can still do that right now through charitable remainder trusts, but the key is that eventually we'll be able to do it through what's called an income annuity. We also, there's a small tax credit that businesses get for establishing 401ks, and you can use $10,000 for your 529 plan to pay off student debt. The other thing that it gave us, and this is really exciting news for all of us that are 70 years old, if we have a kid, we get $5,000. We can use $5,000 of our IRA and not have to pay the 10% penalty. I'm glad you guys got the joke. It is. This is a bone. These are bones. This is not something that really is of any significance to us. There was an article that I read the other day by obviously a very liberal, and she went off on how amazing the Secure Act. And never once did she say the stretch was dead in the article. I'm going, what? You don't understand the significance of the stretch being dead. Well, we also, the new stretch rules that I just said, the 10-year rule does not apply, of course, to surviving spouse. If you're already the kids are already receiving distributions, it doesn't apply to them. It doesn't apply to minor kids until they are majority, and then the 10-year rule hits them. If your beneficiary is disabled, it doesn't apply to them. Problem is, no one's determined who decides if they're disabled yet. No one's figured that one out. It's in the bill, it's in the law, but nobody's figured it out. And chronically ill as well. And it also, if my beneficiary is not more than 10 years younger than me, than the owner. So my brother, if I name my brother as he can employ the stretch, okay? But everybody else has to employ the 10-year rule. You got it? That's the rule. So the question that I have, so I called up Fidelity the other day. Now that this is here, it's law, it's been here for a month, who's going to guarantee that the 10-year rule be implemented? Who's going to guarantee that this happens? Well, first of all, if I receive $1 million in my lap and I'm a beneficiary, I may just party, right? Dad didn't tell me what to do with it. I got it. Here it is. It's $1 million. Let's go buy the Lamborghini. Let's go on those trips. Let's go spend it. And then on April the 15th, be hit with a huge ginormous tax bill. And that's going to happen. Because the fiduciaries, the Fidelities, the Schwabs, they don't have a way to distribute. They have a way to give you or give the beneficiaries the money in lump sum. There's no 10-year distribution. They don't have the ability to do that. That's not their MO. Their MO is to what? To accumulate, not to distribute. So who's going to figure this out? Well, certainly not you, because you're gone. And not the beneficiaries, because they're not going to make sure that the 10-year distribution is implemented. The custodians aren't. A conduit trust will not do that. If you have a conduit trust, you got to scrap it, or at least you got to have Rick Durfee review it and make sure that it is 100% correct, because there are ways to do it right. Most conduit trusts we have seen are wrong. And the answer then is to set up an annuity to make sure that the kids receive it, and the 10-year rule, make sure we can implement that and make sure it's exact. Or we set up what's called a dynasty trust. That's the only way. Those are the only two ways you can ensure that this happens. Those two things have to happen. Okay, so let's look at the stretch rules. Now, in my latest report, the bombshell battle plan that Mark Skousen asked me to write for him, the latest version of it, I have these tables in there. And anyone that's listening today, watching, viewing, will be able to go to our website and get the new version of this report. If you fill out the evaluation form, we'll make sure that you get the old one because you have that, but you'll also be emailed the new one and with all these new information in there. But let's look at this, the old stretch rules. This is the way it was. So as we can see here, when our children inherited the IRA, they ended up with the old factor right here. This is the factor. So if a 40-year-old inherited a $1 million IRA, he ended up having to do withdrawals of $23,000 the next year, and then you can see it keeps going up. So a total distribution in the old rule in 10 years of $322,000, and let's just assume the 30% tax bracket, okay? He was in the 30, and remember now this money is added to their top line. So if they're making $200,000 a year as a lawyer, they now have $223,000. Nothing they can do about it. They got it. Now they can disclaim it and say, I don't want it, I want my grandkids to get it. Or I want somebody else to get it. They can give it to, they can even actually disclaim it and give it to a charity if they want. But this is going to be added to their top line. But look at the tax liability over the 10 years, $96,000. That was manageable. That was something that we could swallow. We ended up, though, with, because we were growing this at 7%, we ended up with $1,500,000 balance in our IRA. So they not only got $300,000 in income, they ended up with $1.5 million still left in the account. Pretty cool. I can live with that. That's a good inheritance. Well, what we have now is the 10-year rule. The 10-year rule says, no, you can't stretch it over your lifetime. You got to take the big hit. And every year for 10 years, you got to pull out $133,000. Goes to your top line, son. But Dad, you're dead. And I just got a raise at work and I'm making $200,000. You just increased his income by $133,000. And what does that do to the rest of his income? It catapults it into higher tax brackets. Remember, we're in the lowest tax brackets in history, at least the last 80 years right now. But that's not always going to be there. We have a sunset in 2025. So look at the taxes, though, are $400,000 over that same period of time. With an IRA balance of zero, it's gone. We had to take it all out. That's the rule. Did the village get pillaged? Absolutely. There's another word with this village pillage thing, but I'm not going to say it on TV, okay? Withdrawals at the end. Well, what if I just say, okay, Dad, I get your IRA, thanks a lot. I don't want to take it now. I want to wait until the end of the 10 years and then take it. So the IRA accumulates at 7%, and now at the end it's worth $1.8 million, $1.9 million, and boom, a tax of $400,000. Do you know you're going to add $1.9 million to their top line for that year in the 10th year? That's not going to be 30% tax bracket. It's going to be at a higher tax bracket. In fact, this is kind of a summation of those three slides here. And in here we have the stretch. You can see the tax liability here is $96,000, $400,000. And here's the big tax right here of the single withdrawal in 10 years. But it's not going to be, it's going to be a closer to $700,000, maybe $800,000 tax liability at the time. No one's going to do that with a clear mind. No one's going to do that. That's a joke. In fact, what's going to happen is this money's going to get whacked, taken out over chunks. Nobody's going to do the 10-year rule. They have to do the 10-year rule, but they're going to take it out in chunks. And it's probably all going to be gone in 2-3 years, unless you set up the proper trust work, or you name or you run it through an annuity, and you make sure the annuity pays it out to the kids correctly. Okay, So this is all in your report. You hand in, if this is something that's of importance to you, check it on your evaluation form, and we will get that information to you. So what are the solutions to this? I didn't want to come here and make you guys all upset and mad. I wanted to give you some solutions, and there are some solutions to it. The first solution is to spend it. This is your money, get rid of it. Use it first. Don't hoard it. Midas says, don't hoard it, please. Spend this money. And spend it fast. Why do you want to spend it fast now? Tax brackets are the lowest they've been in 80 years. We could transfer it to a charity. Remember, we can still transfer, if we're over 70 and a half, $100,000 a year, count it for our RMDs, to a charity. So if you have a charitable cause that you're excited about, do that. You can convert it to a Roth. Well, why would I convert it to a Roth? Because a Roth accumulates tax-free, and it passes to my beneficiaries tax-free. But I recommend that you do what's called a Roth on steroids, that convert it to a Roth on steroids, not just a Roth. Now, I think we should do both, and I'm going to explain that to you here as we go on. So the question then is really spending it, giving it to charity, et cetera, et cetera. Those aren't really the options that I want. I want to know about Rothing. So to Roth or not to Roth is the question. As we know, when we convert a Roth, conversions are taxed as ordinary income, but they create tax-free accumulation, tax-free distribution, and a tax-free inheritance. We also want to convert during the sweet spot, if at all possible, which is 59.5 to 72. Why is that? Because we don't have to do RMDs, and we don't have to pay the 10% penalty if we take out before 59.5. We also can do what's called bracket bumping or tax bracket management. And I love this idea. This is a great strategy. We'll talk about that. Because right now, with the Tax Cut and Jobs Act, taxes are the lowest they've been, as I said, in 80 years. When we're doing these conversions, it's really advantageous if we do them during years where we have huge tax deductions. It's a business loss or some kind of a loss, and you can offset it then. So that's a good time. Look for those opportunities to jump in and do the conversions. So look at this here. This is what we have right now. This is the 2020 federal income tax rate, married, filing jointly. Okay. In here, look at the bracket right here. To me, this is the sweet spot of the brackets. Because if I make $326,000, my top, under that, my top bracket is 24%. Look what happens if I make it more, to 32. And it's only 2% different from the third bracket. So, in an ideal world, if I'm making $100,000 in a year, my wife and I have room of $226,000 to convert. You see what I'm saying? That's called tax bracket management, or tax bracket bumping. And you want to work with your advisor or work with us, and we'll help you figure out where that is. We have prepared specifically for the attendees here at the show, and then those that are listening, the Retirement Planning Solutions Suite, which analyzes all of this for you personally. And we will do that. The suite is $97 for the initial evaluation, and then it can go up from there to $397 if you want us to do the entire plan, or if you want us to do your financial plan, it's $1,900. But that includes all of the tax bracket management, and it's very important that you get that done as soon as possible so you can see, because these brackets are not going to be around forever. So when you're doing that, though, you need to consider state taxes as well, state income taxes. So Florida, no state income tax. Suggestion, for the period of time when I'm doing this Roth converting, move to Florida, okay, and buy a condo. And I mean, seriously, it's that serious. We are running out of time. Why are we running out of time? Because the current tax brackets are set to expire in 2025. We have basically a minimum of 11 months because that's the current law. And who knows what happens in November. But based on current law, we have 59 months left to do that at the current brackets. So it's important that we jump on this as soon as possible. Okay, well, a Roth is only worth what a Roth is worth. And I suggest we do the Roth, but I also think that there is the perfect conversion. I call it the IRA Holy Grail. In this, it's also called the Roth on steroids. It's the perfect conversion. And there's several versions of it, and they're all in your report. The RMD leverage strategy, the wealth creation strategy, the family bank strategy, the IRA reboot strategy, the twist of charity with your IRA, and all of those are explained in the book, and we're going to cover a few of them here today. So let's say I have a husband and wife, George and Sarah. They're both age 72. They're in good health, and they have $1 million IRA between them. And the required distribution is $39,000. We already covered that before. They're in the 25% tax effective bracket, and so they're netting $29,000 of that. They take that $29,000 and they invest it at 6.4% with a 1% investment fee of 5.4 net. That's what we're assuming. Now, if we were to take that and we were to put it into the Roth on steroids concept, and we were to take that and we were to purchase a joint and survivor second to die life insurance policy, that would create $1.5 million of instant net life insurance benefit that goes to our family, income tax and estate tax free, if it's set up correctly. If we could put it in the Roth, it would be worth $30,000 the first year because we earn interest on it. If we had put it in the insurance, it's worth $1.6 million immediately. If we set it up in the family bank, that's the wealth creation strategy. If we set it up in the family bank, it's worth $1.2 million immediately. In 10 years, the Roth grows to $400,000, but it still is far behind the money that goes to the beneficiary from the insurance. And in 20 years, it actually is still behind, still lagging at 7%, earning 7%. So you can see the Roth IRA, the Wealth Creation Family Bank, is actually a better strategy. The Roth on steroids is a better strategy than just even a straight-up Roth if you were able to contribute to a Roth like this. The account comparison is actually equally important. In here, in 10 years, you have $380,000 in the Roth. The insurance policies have $300,000 in the family bank. But look at this in 20 years. The Roth is at $1 million, and the family bank isn't far behind. But remember, the life insurance benefit is at $1.6 million, way ahead of the Roth. So, if we take this and we look at the Secure Act and we can do the comparison again, remember our tax liability here is $400,000. So what if we took this idea of the Roth on steroids and we basically ensured that this tax liability would be covered? Because it's going to be due. So let's ensure that it's going to be covered, so that our kids receive the full inheritance that we intended for them through our IRA and our other qualified accounts. So in this case, the tax liability is going to be $400,000. So let's go out and let's secure a Secure Act solution strategy. Again, it's explained in your report. It's on your little sheet there. If that's something that you want to look at, check it, and we'll share it with you and show you exactly what it looks like for you. But in this case here, we purchased a $500,000 joint policy. And we can do this if we're an individual too, if we don't have a spouse with us, but it's more efficient, cost efficient if we do a joint. And we do a $500,000 joint policy to cover this nut, because this nut's going to increase, hopefully, through the years. And so we have the nut covered here at $500,000. And we establish a dynasty trust, and we put this policy in the dynasty trust. And we also name the beneficiary of our IRA the dynasty trust. That way, if we want to ensure that the kids take it out over 10 years, not in big lumps, that'll happen, and the tax liability will be covered. At the passing of the surviving spouse, the trust will then automatically dictate and withdraw the amount that's needed to pay the tax liability. Pretty simple concept, but this is all 100% locked in. Your IRA then transfers to your family 100% intact, totally intact. Okay, let's look at another strategy, the Secure Act Solution Strategy. So let's say I am 60, my wife is 60. That group was 72. Now I got a younger group. And they deposit into an insurance plan $9,000 a year over 10 years. In 10 years, they're done. They paid up their policy in 10 years. It instantly creates $500,000. Now, this is going back to our example again, that the tax liability was $400,000 at the end of the 10 years. Well, we're also going to be creating a cash account in this policy, and the cash account is going to be accumulating tax-free money that we'll be able to access throughout our life. But this is the key to this strategy. A 60-year-old couple, the rate of return before tax is 11%, after tax is 11%. 11% is what you would have if you took that same $90,000 and invested it. You would have to pull down 11% year after year after year after year without a 2008, without a 2001, and you'd have to pull that down every year to equal the rate of return that you're going to get on this plan. So this is, again, a way in which you could ensure, A, that the kids receive the distribution, no matter if you're 60 or 72 or 85. You'll be able to make sure that they receive this inheritance, and the IRS tax liability is covered, but it's covered by the insurance company. Okay. Here you're going to transfer a total of $90,000 because it's 10 deposits equals $500,000. That's a 5.5 times return of every dollar. For every dollar you put in, you get $5.5. This strategy, this Secure Act Solution Strategy replaces what Congress just took away. So they pillaged our village, but we can get our village back. We can make it whole through this strategy. If that's something of interest, check it on your sheet. You can also include, if you want, a long-term care benefit on this plan that in this example here would be worth $10,000 a month to the surviving spouse that can't do 2 of the 6 activities of daily living or is cognitively impaired. So you can triple it up and have it be a wealth accumulation vehicle as well as a long-term care and, of course, a life insurance plan to pay the tax liability. Okay, I love this strategy. I just came up with this idea of the stoplight, stop and go. Let's say I'm doing my tax bracket management, and this year it's really a great tax efficient year for me to do this. So I put in $40,000 this year. I get my plan, it's $1 million of coverage. My wife and I are both 60 years old. I get my coverage. I'm putting in $40,000. But next year, I make too much money, and I can't, or they change the bracket, and I can't do it. Well, shut it down for that year. Shut it down for that year. And then on this year here, I have more room, so you can put it in the next year, and you can shut it down and put it in. And the idea is that you can have this plan totally paid up, and you kind of gauge how you want to do it. This is not mandated. Only the first year is the one that's mandated. The rest of the years are not mandated. You can decide. Okay. This allows you for total flexibility. This concept is a very, very simple concept. Here we're taking out a family bank strategy life insurance policy, and this is a 64-year-old male, and he has an IRA of $500,000. He's going to do, instead of doing a Roth conversion into a Roth, because a Roth is only worth what a Roth is worth, he's actually going to take that $500,000 and transfer it into the IRA reboot plan. And in this IRA reboot, over 5 years, he's going to pull out of his IRA $105,000. And we actually have an account that you can invest in your IRA that will give you this kind of payout, $105,000 over the 10 years. I'm sorry, over the 5 years. And then from there, he creates $1 million, $1.3 million life insurance policy from this $105,000. So what's my leverage? I put in $500,000 over the 5 years. I have $1.3 million of instant and perpetual life insurance coverage. That's going to pay the tax liability and replace the assets for my kids on the other assets that I have. But anyway, we set up the family bank policy, and then instead of you paying the conversion tax like you would have if you had done your own Roth, the insurance company pay the tax liability. And you have them do that because you take out a policy loan of $25,000 year 2 through 6. And the policy still remains intact. Now your life insurance benefit is reduced because you're taking money out of it, but it's still over $1 million net death benefit to your family. So this again, if that's something that's of interest, check it and on your evaluation form, and we'll discuss it either here at the conference. We have a few appointments left. Todd is in the back. Todd, where are you? Todd's in the back, and he has our appointment scheduled. We have a few appointments left. If you'd like to talk to myself or Rick or Todd during the conference, just tell them which ones. We have a little stickies, and it tells you where the appointments are. And we'll see you here at the conference. If not, check that you're interested in of any of these ideas, and we'll talk to you later. But make sure that you fill out the evaluation form and either return it to us here or at the booth 511 to get the free Bombshell Battle Plan Special Report. And all of you that are listening online, if you would like to get the free special report, make sure that you call the office or you contact us online. And I don't know that we have the actual number here on this slide, but I'll give you the number. It's 888-892-1102, 888-892-1102. If you'd like to discuss that further, any of these ideas, any of these concept strategies, what the Secure Act will do to you, and make sure that you get your estate analyzed and your retirement plan, your 401ks analyzed and run it through the Retirement Planning Solutions Suite, and make sure that you get that done as soon as possible because it's critical mass right now. We are running out of time in taking care of this. Also at the booth, if you would like to get our other books, The Family Bank Strategy, Leverage Care Solution, The 10 Most Common, and The Gift for Life, all of these books are there. This one here is on Amazon for $25, the Family Bank is. You can get them all for $20 if you go to the booth and get those. So I think that's all I have for today. Thank you so much. I think we were pretty much in time. We have 1 minute left. We'll talk to you at the booth. Thank you.